Hello, everybody. It's V from Lifestyle Refinance. Welcome to l'entretien. Today, I have Wilson Fung, and Wilson is from House of Wealth. So, Wilson, would you like to introduce yourself? Go ahead.
Hello, everybody. This is Wilson from House of Wealth. I'm the director of House of Wealth, and we specialize in property tax. Well, today we basically want to run a few demonstration when invest into property. What's the best structure to invest into property? Firstly, I like to share my screen
Yes,
with you
please.
guys. All right. And we can run through some figures.
That's
Can
wonderful.
you see the figure, Veena?
I think it was better earlier.
Is that better?
Yes.
All right. Now, I suppose when come to property investments, a lot of clients, they always invest their property in their own name. So what I like to do today is we run through some figures, and with different structures. We have a individual structures with a company,
Yes.
so many super funds, and a discretionary trust and a unit trust.
Fantastic.
Okay, all right. So looking at the figures, let's assume the rental income is $26,500, and all the expenses, the rental expenses.
Yes.
I mean, that will include agent fee, council rate, garden, insurance, interest expenses, repair, maintenance, and waters, and of course some capital allowance. This is the depreciation.
Yes.
So we say is $33,150.
Mm-hmm.
Right. Taking away from the income, the net rental losses is $6,650.
Mm-hmm.
Okay. Traditionally, let's assume an individual have $180,000 income.
Yes.
Right. And say they also have some other investment income of $1,000.
Mm-hmm.
Right. Traditionally, these losses,
Yeah.
the client can offset against their mainstream income.
Correct.
Right. So their estimated taxable income is $174,350,
Mm-hmm.
and that we estimate their tax payable is $53,064. Okay. So
Yes.
let's go through if a property was if the property was invest in the company structures.
Mm-hmm.
Same thing, rental income $26,500, expenses $33,150,
Yes.
and there's a rental loss of $6,650. Now, unfortunately, these losses cannot be offset against an individual income.
Oh, yes.
Okay, this is because basically this is a two different
Okay.
entity.
Hmm?
Okay, so put it this way: the clients have $180,000 investment income of $1,000. His taxable income is $181,000.
Mm-hmm.
The tax payable is $55,737. So same thing with any other structures: some in a super fund,
Yes.
discretionary trust,
Yes.
and fixed unit trust. Unfortunately, none of these losses can be utilized by the individual.
Mm-hmm.
Okay. And you probably ask the question, why do we need to, why so look like individual structures is the most tax advantage?
Yes, that's a good question.
If you compare to any other structures, so look into it. See that the individual tax return is going to be the most tax advantage by saving the client $3,600 every year in tax.
True.
True. Okay, but let us look into it. What if the client 10 years later they want to sell the property?
Mm-hmm.
Let's say the property now is worth $1 million.
Mm-hmm.
Initially, they purchased is $475,000.
Yes.
Right. So gross capital gain will be $525,000.
Mm-hmm.
Right. So same with any other entity. Let's go back to the individual. Okay. Now the individual have $262,000. So the gross capital gain of $525,000. Of course, because the property was held more than 12 months,
Yes.
then the property entitled to 50% discount. All right. And 50% of the property, the capital gain will require to include in the individual's tax return, which is $262,500.
Yeah.
Right. So now their taxable income has increased to $436,000, and their tax payable is $175,987. Let's look at the company.
Yes.
All right. Company have okay, because it's a company cannot entitle to any concession discount.
Mm-hmm.
Okay, so $525,000 of the capital profit required to include in the company as treated as an income. Estimated company tax will be $155,000. Sorry, estimated taxable income for the company is $518,000, and estimated tax liability for the companies is $155,000. Right. Let's look at a Salmon and Super Fund. Okay, because Salmon and Super Fund, there is a concession. There's a concession. Okay, for Salmon and Super Fund, unfortunately, you're not entitled to a 50% discount. You're only entitled to 1/3 of the discount. Right. So estimate net capital gain for a Salmon and Super Fund is $350,000. Right, and taxable income for the super fund is $343,000. Tax payable is $51,000. Right.
Yes.
Okay. Okay. Let's go into both the discretionary and unit trust. Same thing. A discretionary trust entitled to 50% discount,
Yes.
and therefore $262,500 are required to include in as treated as an income. Their taxable income is $255,850. However, we need to distribute it to an individual. So if I take that 255, including into the personal tax return, so an individual taxable income has increased to $436,550. So doesn't matter you're using a discretionary trust or fixed unit trust, and individual taxable income has increased to $436,000. Tax payable, $175,987. Right. When you come to a super fund, we estimate a super fund tax payable liability is $51,503, and individual income who have $181,000, their tax payable is $55,000. Right. So their overall tax payable combined their super and their personal tax return is $107,240. Compared to an individual,
Yes.
$175,987. And when we look into the company tax, okay, when we combine company tax rate as well as the individual tax, is $211,000.
Correct.
Okay, this is where that is why when you come to investment property, so we always not recommend a company to invest into a property. Right. So out of this five entity, you can see a self-managed super fund is the most tax effective
Correct.
out of these
Correct.
structures. Right.
And yeah,
So having said that, so we haven't taken into account, say, what if this super fund now become a pension income fund?
yes,
If the super fund at the point they're selling the property, it become a pension fund, then the $50,000 will be waived, will be tax free. So what I'm trying to say is that the $334,000 is basically tax free for the super fund.
yes. I think the important takeaway today is being to understand the structure, because we do have lots of investors in the market, and investors sometimes they don't know what is the best structure. So sometimes they come to us and they want to buy 2 or 3 properties, and they already hold 2 properties. So that's where the expertise of a property tax accountant like yourself is, is viable, because they need to know and understand different structure and where they will benefit the most. So I think today, Wilson, having got this Excel spreadsheet, you have, I think, detailed out thoroughly the difference between the individual, the company, self-managed super fund, discretionary trust, and the unit trust, and have presented it in an excellent way where people can see clearly the taxable income. They can see clearly where they're going to benefit and what structure will suit them the best. So in the property market at the moment, I know that there are lots of first-home buyers, but at the same time, there are lots of investors as well, and they want to know the best structure to invest. So I think I will put your details out there, and if we have clients who would like to reach out to you to understand what suits them, they can easily reach out to you, and I'm pretty sure you will help them to structure the best way to
The best
invest.
structures.
Yes,
That's right.
So today the topic was property investment and types of tax structure, and I think Wilson, you'll be best to do a follow-up on self-managed super fund and investment. Maybe we can keep that for next time. So
Yeah,
is there is there anything else you'd like to add today?
Okay. One thing I'd like to add is just be careful, because every person have their own personal circumstances.
Correct.
So just please don't just use this as an advice.
Yes.
You need to come and talk to us, and then before we can recommend what's the best structures suit your investment property.
Correct. I totally
That's all I
agree
can
with you.
say to you.
Yeah, I totally agree with you. And I always say this, when someone is purchasing a property or if someone is taking a loan or investing, it's not only about the client or the mortgage broker. It's also about, taking the advice of a financial planner, of a tax accountant, of a good solicitor or lawyer, and so forth. Because at the end of the day, this is how everyone's expertise is required to best support the client. So I really appreciate your time and your effort today, Wilson. Thank you kindly, and thank you for putting in so much efforts in the work today. So thank you everybody, and we'll touch base again, and probably we'll follow up with self-managed super fund next. Thank you.
Thank you.
Wilson.
See you.
See you.